If you're thinking about buying a business, there are going to be a lot of acronyms that you're going to learn. In the normal operations of a business, you're going to run into acronyms like COGS, cost of goods sold, EBITDA, earnings before interest, taxes, depreciation, and amortization. You're also going to run into unique acronyms to the acquisition of a business. And the one we're going to talk about in this video today is SDE, Seller Discretionary Earnings. By the end of this video, you're going to have a better understanding of what this acronym means and how to calculate it so that you can better understand the value of the business you are looking to acquire. Hi, my name is Barrett Young, and I'm a partner here at GWCPA, and we help businesses through the succession phase of their life cycle. There's a lot of confusion around the acquisition of a business, especially because there are going to be new terms that are introduced to you, especially if you've never run a business before. One of those terms is SDE, Seller Discretionary Earnings. SDE is a term that is unique to the buying and selling of a business. It's not a term that comes up in the everyday operations of a company, and so there can even be confusion on the seller's part when we get to SDE. SDE is trying to capture what are the actual operating cash flows of the company. After revenue, cost of sales, and overhead, what is left? Now, there is a term that is used in the operations of a business, and that's called EBITDA. That's earnings before interest, taxes, depreciation, and amortization. This is effectively operating net income of the business. The difference between that and seller discretionary earnings is that seller discretionary earnings would include amounts that are available to pay officers of the company. It might include backing out other discretionary expenses within the company, like the owner's cell phone, vehicle expenses, if there are any family members that are on the payroll of the company. Even things such as donations or excessive meals and entertainment expenses could be backed out to get to a seller's discretionary earnings amount, SDE. Other expenses that are going to be backed out of the normal operations of that business, the financial statements that are provided to you by the seller, could include one-time expenses. If there is 1 year out of the years that you're examining that has excessive legal expenses, you would want to find out about those legal expenses, see if they were related to customer warranties, customer satisfaction. They might be personal legal expenses sometimes run through the business if the owner is closely holding that business. If it's a one-time thing and not a regular operating cost, that is something that you would also be removing from the operating expenses of that business. There are other operating expenses or margin issues that you might want to be aware of when you are getting to SDE. If there are preferred customer discounts, if there is old adjusted AR that finally got collected in a certain year, that AR could have been deferred years down the road and finally collected in year 3 or 4. That's going to be out of the ordinary revenue. And so you would want to adjust that out of those financials also. It's not a picture of true economic growth of that business. Those are normal costs in the operation of a business, but those are up to the owner's discretion. And so this SDE amount is going to give us an adjusted EBITDA effectively. So when you buy this company, how much cash is available to you as the owner in order to fund its expansion? If that owner has been working in the company up to this point and you're going to have to replace them as an investor in the company, not stepping into that job yourself, you might need to add back a reasonable compensation for that operator within that business. And that comes out of SDE because that is your discretion not to operate that business, but to hire somebody else to do it instead. That would get added back in to get to an actual cash flow to you as the buyer. If you are buying a capital-heavy business, so a business that needs regular inflows of capital in order to keep it operating, not a business that buys a piece of equipment every couple years, but a business that continues to make capital acquisition purchases year after year, and that's essential in order for the business to keep operating, then you would also probably want to add some CapEx into the operating costs of that business. It's now going to come out of seller discretionary earnings, and it's going to go into the operating costs of that business. So while we're talking about that, you might ask, why does seller discretionary expenses happen above EBITDA in a financial statement? Why would we not take into account important expenses in running a business, such as interest, taxes, depreciation, and amortization? The reason for this is because those are costs to the business, but they're not operating costs of the business. The operating costs of the business are what are the actual true costs of running that company. Whereas interest, taxes, depreciation, and amortization, these are going to be based on the buyer or the investors in that company. So if a buyer comes in with a cash deal and does not finance the company, there's not going to be any interest expense. Whereas a buyer who comes in financing 90% through an SBA loan, there will be substantial interest expense in the non-operating costs of that business. It's the same for taxes, and this is going to be based on how you structure the business after you acquire it. So if that business is structured as a corporation, it's going to have a different tax rate for federal and state than it would if it was operated as a pass-through business. If you are self-employed and operating that business, you're going to have a different tax rate that's going to come out of that EBITDA. And so that's why the expenses that are traditionally contained within EBITDA are going to also be treated as seller discretionary earnings. Depreciation and amortization, another case. If you're buying that company, you're going to have new amortization expenses. That's going to come out of your discretionary earnings because you're buying the goodwill of that business and you're going to be amortizing that over the life of that goodwill. A minute ago, I already referenced capital expenditures, but if you're buying equipment irregularly, you have discretion over the depreciation of that equipment. And so that's why these things are under SDE, do not fall under the operating costs of the business. The purpose of coming to the SDE amount or EBITDA, whichever one you're using, is to find out what the actual cash flow within the business is that it generates that's available to you as the owner. This cash flow has got to service the debt that you're going to use to acquire this business. This cash flow has got to provide for you in the form of either compensation or distributions or dividends as the owner of that business. It's also got to provide for the capital purchases in order to keep that business going. All of those things are going to come out after taxes. And so when you do your cash flow projection, it's typically going to be based on seller discretionary earnings, and it's going to be tax adjusted. When we are buying small businesses, even though the entity itself might not pay taxes, if it's a pass-through business, the taxes are paid at the owner level. You still are probably going to want to see what the tax effect is from that investment in the company. So if you're looking at a business with an SDE of $500,000 and you're not tax affecting it because it's a small business, a pass-through business, when you actually get that revenue into your pocket as the owner, it's probably going to be closer to $280,000, $350,000. And if you're not taking that into account in the purchase of that business, you're going to be surprised by that. Similarly, you're going to have to service the debt of the acquisition, and that's got to come out in after-tax dollars. There will be some tax savings from the interest on that debt, but all those principal payments are going to be coming out of that after SDE figure, and you've got to take that into account. Certain lenders like the SBA and other bank loans might not even lend you the money, regardless of what the purchase price of the business is and whether if you have 10% to bring with you to closing or not. They might not lend you the money if the cost of servicing that debt is going to be too high of a multiple of seller discretionary earnings. So for example, if you've got $500,000 worth of SDE, and after you've tax affected it, it's down to $300,000, and the servicing of the debt is going to be close to $150,000, the SBA is going to have an issue with that. You've effectively got a 2-to-1 ratio of after-tax SDE to debt service. That's not going to leave a lot for you as the business owner in order to make other decisions within that business. And so some lending programs might have an issue with that. To examine the ability to service the loan, it's also going to factor in, as you know, into the value placed on that business. The last thing that I'm going to look at as a professional when I'm doing a quality of earnings on a business is I'm going to want to look at the span of years that are provided for information. Now, for a full valuation of a business, which is usually done on the seller side, not a buyer because you don't have access to information, your professional generally won't have access to information unless it is a family business succession. On the seller side, in a full valuation, they will probably look at 10 years of information. In a quality of earnings on the buy side, we're probably going to have 3, but hopefully 5 years of information. I'm going to be looking at the growth rates of both the revenue and the seller discretionary earnings over that course of time. Is it linear? Is it spotty? Is it every 2 years? So up year, then a down year, then an up year, then a down year. Is that something that we need to level off? Is it exponential? Is it at a faster rate of growth more recently? Considering some of these things, it's very easy for a seller to want to take last year's performance and project that out as being linear. So last year it did X and it's going to continue to do X, or it's going to continue to grow 5, 6, 7% over the long term. As a professional, I will weight the cash flows of that business. And so I will give a heavier weighting to certain years based on if I think that the growth is linear, or if I think that it is faster as you approach the current year. And so this is the benefit of having more information, more years to examine. Another factor that's not so big now as it was a couple of years ago, but still something that we want to keep in mind because it's within that 10-year period. I would love to see financials for a business pre-COVID, during COVID, and in the years since COVID, just to try and see what did the business look like before this massive situation occurred. Did supply and demand tank in the years following COVID, 2020, 2021, even 2022? Are recent years of growth just a bouncing back to that pre-COVID number? Or was there a lot of demand during the COVID years because of the type of business that you were buying? There are some businesses that boomed when everybody was at home, everybody was ordering online, everybody was having things shipped to their houses. There were certain businesses that did better in 2020 and 2021. And so I want to see what that effect looks like over the past 7, 8 years of that business. That would be my preference as an advisor to buyers. And the last piece I'm going to examine in a quality of earnings report is I want to see the tax returns. Financial statements say one thing, but unless that company is required to issue financial statements in order to get bonded or required for a line of credit, those financial statements are typically management use only, bookkeeping statements that are provided to them to make the decisions to run their business. What actually goes on the tax return is signed by the business owner and it's signed by a reputable tax preparer. And so I'm going to turn to those numbers and I'm going to see what are the differences between what the book net income says and what the tax net income says. Tax net income isn't always accurate because you make decisions for taxes, for example, that are more beneficial for tax purposes, but I do want to see what the difference is between those two in the preparation of a quality of earnings report. The due diligence period in the acquisition of a business moves very fast, and so you have a limited timeline, typically 30 to 45 days, between the letter of intent and the actual decision to acquire that business. And so a quality of earnings is a fast and cost-effective way of getting beneath the documents that the seller has provided to better understand the valuation that's been put on that business. If this video has been helpful for you, I've got tons of content on this channel about this very topic. You can find the best one of those videos right here. Otherwise, please like this video, and I appreciate you watching. I will see you on the next one.